Hi, everybody. I'm Nandini Mansinghka, CEO of Mumbai Angels, and I'm very happy to be here and chatting with Akshay.
Nandini, quick overview of what's your background and what got you interested in startups in the world of startups.
Yeah, so it's been a long checkered journey actually. So I hail from a Marwadi family in Calcutta, way back in 70s 80s, where you know we were I think the primary thing that I was told when I was growing up is that look, you have to get married and have kids basically. So I think that's where the that's where the journey started. And then I quickly just looked around and I said, no, this is not what I'm going to be. And I had very supportive parents, and I had my siblings were very supportive, and I basically started charting out my path from there. And it was actually not a very premeditated journey. I basically fumbled along. I said, okay, what can I do? So I was relatively good with studies. So I said, okay, now let me just try and do higher studies. So for me, getting out of Calcutta was actually the primary driving force when I moved to Delhi, and that's where I did my CFA. So this is the combined program, where you do the CFA and MBA together. And this was way back in 1995, I think. Yes, 1995. So I did that, and then from there on, I was again, just fumbling along and saying, what are the things that I can do? And I've actually had a very checkered career on doing a wide range of things. And one of the primary places where I could learn this was at the Times of India group. So I joined the Times of India group in their internet division. I was like, the sixth employee. That's the time when there was no Google, there was no search engine. And uh, I've actually experienced a startup environment and culture in that organization, where you were just these 10, 15 people in a room. And I was actually told, that, oh, here is, and that time our go to platform was Yahoo. So we were told, okay, here is something called Yahoo Auto. Can you build something called India Times Auto? And I would just go with it from the beginning, and I have zero ideas about automobile, but I would do that. And then you would say, okay, fashion. I had zero idea about fashion. You do that. Then I've built, so all these verticals of India Times right at the nascent stages when you were just building HTML pages, etc. I've been a part of that journey. And then from there, I think,
The approach of Times of India was to build online classifieds because essentially a newspaper earns through ads, and one way to like diversify your revenues to create online classifieds. So you earn through online ads.
so
So
that was actually a different, absolutely. So it was online classifieds, but I was a part of the India Times group where they were not really looking at that as an extension of the print business. They were actually wanting to become a global uh, platform at that time competing with Yahoo.
yeah,
So
yeah,
that's what we wanted to be the Yahoo of India. So you said we actually started saying, okay, what all is there in Yahoo, and you start. So I was also trying to build, something called a web directory. So to actually go, I had a team of people who would go and look for websites and put lists together. So I'm talking absolutely pre Google age, but it gave me a lot of understanding of how to actually stop saying this is what my skill set is, and just do whatever is out there. And the so post India Times, within Times of India group, I actually had the fortunate experience of being a part of what was called the central strategy group of the entire group. And that was another experience by itself, where one day I was working with the legal team, then marketing, then finance, then business, radio. So you did everything. And that was, I think that's when the seed of entrepreneurship actually you know was with me. Post that, I, of course, I've so then from there I took another, absolute 180-degree turn when I shifted from Delhi to Mumbai, when I joined JP Morgan. Now, from a completely unstructured environment, I was in this completely structured, multinational bank, who where you are very clearly told this is your role, please do this well, and more importantly, do this with as much precision and detailing as you can. So that's the other part that I learned, which I had not learned earlier, so where attention to detail, where every dot, every comma mattered. So that was that other learning that I had, which I think was a fabulous. So you actually got this full sense on how to run anything end to end. This I did till about 2010.
JP
And
Morgan does banking in India, or this was like a back office for US,
so this was the investment banking research group. So this research group, actually, so I
like a
wasn't the time.
KPO.
Yeah, no, so it's the so you work with the India office also, and you work with internationally all the offices, where you were actually for every pitch that was going out to the client, the team was doing everything except for actually pitching. So, like for example, I was, how I came into this is because I was the media. I was the, I'd looked at media from time. So I came into the media group in JP Morgan, where my job was to actually build the pitches for any client you are pitching to across the world types. And then, of course, I moved to the telecom media technology group, etc. Uh, yeah, so that is what was happening in 2010 or so. 2010 is when I realized I can't do this anymore. I had to just jump off and do my own thing. And I quit in 2010 on a business idea that I actually junked within a week of quitting on the Excel sheet. I said, so I was, trying to do something absolutely bizarre, like a self-publishing website. I said, I said I will do this, and I sat down and I looked at the Excel sheet with my brother and my husband, and all three of us, we said, no, this doesn't work, so cancel. So here I was at quit, and 1 week, nothing. I think what is very important for anybody who's listening at this point is, at no point once I quit did I ever regret saying, oh, I should have gone back. That I think is the core of what entrepreneurship is. It is a lifestyle choice. It is not a one job versus other. And the minute something starts not going okay, you don't just jump back and say, okay, let me. So I think that was very critical. And then from there on, 2010 to I think about 2016, 17, right? I actually tried, I think, four to five different businesses. Okay, couple of them were just at the idea stage. Some I just tried and I did it for 3 4 months, didn't
Oh,
work.
just talk a bit about each one of those.
So, see, I think initially the minute you do this, now the first thing you start telling yourself is that you are this fabulous consultant. I think this is this consulting. All of us have this chip on our shoulder that I'm an investment banker, I'm JP Morgan, and here is this queue of people who are, wanting to learn from me. I did that. So I said, let me set up an investment banking unit of my own, right? And I did this for some time, and I said, not happening, not scalable, not spending my time or energy. So several of these, consult. Then I actually thought of setting up an incubator way back. I said, look, this can be done, etc. Uh, so these were the two specific ones that we did. Then came Idea Booster. So Idea Booster was my first attempt at a business that actually took some shape and it went some distance. This was actually if you think of angel funding for content. So what I was trying to do at that point was, can I actually, fund movies, TV series? That time, of course, there was no, you didn't have so many. I think it was just an idea before its time, because today maybe it would work. But
Yeah,
at that
it
time,
sounds very interesting, like a Kickstarter for entertainment.
yes, yeah, and that's for equity, So you're doing it. So I actually also managed to produce a, like, fund and make a movie. This was a Bengali movie called Ludo, and it is on Netflix. Watch it at your own peril, because
Okay.
so this is not the Hindi Ludo. This is a Bengali Ludo. It's a horror film. But once I made Ludo and I spent that money, and I was just lucky to be able to return money back to my investors. So people did not make a loss. But I realized that this is not scalable. So I would either have to do 100 movies of a crore each, or I would have to go into, you know, the more the larger ticket size movies, which is a very different business. So I said, no, this is not happening. While I was trying to sell Ludo, is then I realized that, look, here is this other gap in the industry where there are a lot of people who have content and they don't know how to reach out to buyers. So that is how DigiBooster, uh, you know, came into being, where we said, can we actually create a platform where, and that time, of course, you didn't have the Netflix and Amazons who are so active that, like I'm saying, I think we're talking 6 years back. So way ahead. I think I was a little early at that time also. So we tried that for some time. And uh, while I was doing it, Akshay, I realized I didn't understand content. So I realized that my strength is creating a platform. I know how to bring buyers, sellers together. I know how to actually create a marketplace, but I did not understand how to price content. So if you give me two movies in front of me, I did not have that gut feel to say this is worth 5 crores, this is worth 2 crores, and that is a disaster, right, for somebody to do this. That's when I realized I need to step off, and this is not my game. So this was the journey that was going on. And what I did is I actually got an investor in, and we tried to do, we actually tried. So then I stepped off and I said I'm no longer active, and I got an investor, and we got a CEO together, and we actually moved into influencer marketing. So that was again way back in 2018, 19. I'm talking 18, yeah, 18, 19. I think they tried it for 2 years, but then again, I think COVID got us. So we shut down DigiBooster in early 2020. So that is, so those, while these conversations and these experiences were going on, in parallel, what I had done is in 2010 itself, I had actually joined Mumbai Angels, as an investor. So, and that time it was a very small group of some 20 people doing, 5 deals a year type of a thing. And that's where I found,
How
if
was it structured? Like, was it structured as an
no,
AIF, or just
no,
like bunch of people investing together? So each one signs an agreement individually with the startup, and
absolutely, absolutely.
all
And
of
we
them go on the cap table.
absolutely. So
Okay.
actually, that was our. I will come to how Mumbai Angels is structured today. That was our model actually, even as late as last year,
Hmm.
where
Okay.
people were coming onto the cap table directly. But the difference between that time and, a little later was it was very small, some 15, 20 people, and doing 3, 4 deals a year. That's it. You're very happy because,
And
you,
these were like what, like old school industrialists who had money, or what? Like,
it was a mix. So India actually, the angel investing scene from the time so I've been now a part of this is 2010. It's always been a mix, it's always been a mix of uh, first to third generation entrepreneurs. So the minute it comes third generation, you're talking people who are sometimes who are in their 20s, and they have enough, family wealth to be able to deploy this. So, and India, that's always been the structure from the beginning. So, so that happened, and I did some investing as an investor over there. And while I was trying to build my other ventures, I was quite excited about Mumbai Angels. So I started spending time there pro bono. I was a part of the screening committee. I was part of, portfolio, lot of things. I was leading deals, etc. And of course, Sasha and Prashant, who had started this as a network, they'd become very good friends. I think in 2017, so same, I think the same time when I said DigiBooster is not working, is when I started having a conversation with Sasha and Prashant. I said, look, here is our opportunity to actually make this really big, but this will require a complete rethink. It will require it to be run like a company, with the focus on building value in the company, not just the investments that you do. You have to bring in professionals, you have to build processes, just how any other uh, you have to build for scale actually. So to their credit, they understood, what I was saying, and then I came in as the co-founder, third co-founder, and the operating partner, and they took a investor seat on it. And
Both of
2018 on.
them were like running individual businesses, and this was like a side gig for them.
Yeah, yeah, absolutely. So, I mean, just for perspective, Sasha is a part of the Onida family, and he's actually
Mirchandani.
the
Okay.
GP of K Capital, which is itself a huge name in the startup space on its own. And Prashant Choksi is a part of the Asian Paints and Choksi Chemicals and real estate. So they have huge, large family businesses, and this, of course, was a that this was more something that they had done out of passion, but they didn't. Neither of them had the bandwidth to be able to jump into this full time. And so I jumped into this full time 2018. And I think 2018 to 2021, a lot of, so the growth or the name that you see in Mumbai Angels is basically a function of what we managed to create in those 3 4 years. We managed to create processes, we could
One
build.
one question first before this. Uh, did you have a like a benchmark or a template in mind that okay, I've seen this organization do this in some other context, and we should try to do it in a similar way, or like what was the vision that you had in mind, which you would have probably sold to Sasha and Prashant?
I think it was a lot like AngelList. So I really love the way AngelList has been structured. I just think that Naval has a fabulous hold on this space. So that is the way that I actually wanted to look at it, to say, can you actually become uh, a true platform
Okay,
where
what is, for people who don't know, what is AngelList? Why are you so inspired by it?
So AngelList, see, now they are. I look at them as a peer, because I think now in India, especially, we are as big or bigger than them. But if you look at them from the international context, I think they've really got this, early stage venture investing right. They've put a lot of money behind tech, so I think it is primarily a tech play. Where you're being able to bring in a
Just
large.
describe what is it like, what are
So
the
it's a
various
platform
pieces?
where it's a platform where you bring in a large number of investors who are wanting to invest in startups, and a large number of curated startups. And the role of the platform, like any true platform in any other industry, would be to be able to provide enough information for each individual investor to take their own call. So it is about saying, and because it is an unlisted space dealing with an asset class where there isn't enough information available, you have to bring in that level of consistency in the information that is out there. So if an individual investor logs in, they should be able to look at various parameters and understand the lingo and make their decision. So for people who are that is what we have also now arrived at. It is basically the role of any platform in the early stage venture space is to, like I keep saying everywhere, that when investing in early stage venture is anyway very risky. Okay, anybody who does this should know that your money can go to zero. That's the, if you should have that appetite to be able to jump into this. Having said that, the role of the platform is to homogenize the information, give as much information that is possible for the individual investor to take a call, and more importantly, uh, do the due diligence of the investment before the investment is made, and manage the portfolio through and through. So imagine a platform being a fund manager without taking a call on behalf of the investor, but doing everything else. So that
Okay.
is the you know uh, that's the vision that I started out with. And You know,
So
yeah.
just a little bit more, I want to zoom in. So essentially, you're saying a platform should do three things: homogenize the information, uh, and then execute the transaction in a way that is friendly for both parties, and then manage the portfolio.
Yes, and due diligence is a huge part, huge
Right.
part.
Okay.
So
Okay.
that is the pre-investment piece, which so
So due diligence would lead to the homogenization of information.
no
I would no.
homogenization is before.
Okay.
So like just to give you a context of what I'm talking of in terms of numbers, like say for example, look at us today. We see about 500 deals a month. Okay, we curate only 20 of that to our investors.
So 20 of those have gone through due diligence or have gone through homogenization.
Homogenization.
Okay.
So
Okay.
there's still no, so there is an internal due diligence and there's an external due diligence. So the homogenization is actually also internal due diligence, where we are saying,
Okay.
acha, claims, jo, if the founder is making claims, are they validated? Have we spoken to people? Have we done, just basic checks. That is homogenizing. And then of course putting the information out which is readable uh, for everybody. So it's a curated, homogeneous pipe, let's just say.
Got it.
Then when people actually say yes, I'm interested, so assuming we are raising a crore and 20 people put 5 lakhs each, okay, then the role of due diligence comes in, where we will actually go deep in as much as possible in a startup phase to say yes, we think this is a clean investment to go into. We are still not saying it won't fail. That's the nature of what you're doing, but you try and take the risk away of everything else except the business. So that's the second bucket. And then of course is managing the portfolio right till the exit. uh, I mean, I don't know what is the depth in which we can go on these conversations, but for anybody who's actually wanting to talk to investors and looking at it, see, I see a lot of focus just on valuation. Valuation is just one part of the deal structuring. There are The primary deal structuring is actually around rights. So we actually look at a we do we are known in the market for actually the way that we stitch the deals, the depth in which we actually look at these rights and information, etc. And then when the next round investments happen, our job as a platform is actually to represent the investors and stand there and make sure that our rights are protected. So in my head, okay, and as how we function, we are very clear. Our primary customer is the investor. The startup is a partner or a product or the issuer.
Amazing. Okay, amazing. That's amazing insight. I want to zoom in on each of these steps that we spoke about. So let's start with homogenization. Now, does that mean, for example, you will say that okay, this is the total addressable market? So the total addressable market becomes a standard field for every startup, or would you do something like a uh, discounted cash flow? I doubt that would really be relevant for early stage investing. But what happens in homogenization?
Yeah, so very interesting question. It has a long winded answer. So we do two things over here, right? One is through technology, and the other is through a 20-member strong team. Okay. So what I mean by technology is that we have what we would like to call just the version one of an algorithm in place. It's just version one. I actually think there will be version 1,000 of it. Okay. This is the first step that a founder goes through, where we actually ask them a series of questions. Okay. And basis the backend algorithm that we run, and right now it's a very rule based algorithm. Over a period of time, I think it'll also be, through, as we get more data, and it'll also throw up outputs on data. But basically we look at, and we have divided it into some 7 8 different sectors on what parameters are. When I'm saying homogenization, the parameters for say a SaaS will very differ a lot from what is will be a consumer or say a deep tech, space tech. So I can't just say these are the eight things. But I can say this industry has these 10. Right? Then I try to bring a score which is, internally we look at saying it has to be a 700 out of 1000. Otherwise, this doesn't go through the gate. Okay. When it goes through the gate, and that's the first voice, it's not the last voice, the first voice. Then our team of 20 people, okay, they are going to start looking at the, so let's look at 500, say all say 700, 7 on 1000 score actually will come to only about 50. 450 don't even clear it. Okay. Of that 50,
How is this scoring done? Just as a rough example or something.
so it's an algorithm, like I said, it's about there are 100 different parameters.
Mhm.
And there is an hour and a half call between the founder and one of our team members, and they will ask you questions and they will input answers, and then the odd score is done automatically. So the person who's asking question doesn't know how the algorithm works.
But very top level understanding, like for example, you the score would be low if there is a solo founder, or the score would be low if it's a, let's say, whatever. I mean, you might have some insights
Yeah, no,
around what.
actually, yeah. Let's just say this that uh, score will be low if you're a D2C company and you haven't sold anything as yet,
Okay.
right? Or so, and all, and our threshold of what is a good monthly run rate for a D2C company will keep going up and down depending on how the market sentiment is. But on an average, I would say, hey, 10 lakhs should be there. Otherwise, what are you doing? So if you say, oh, my monthly run rate is 5 lakhs, so your score is lower. If you're not a full-time founder, your score is definitely lower. Those kind of things. If you're a SaaS company, we are saying that, okay, have you got your first beta customers? If you are saying I'm a patent company, is your patent filed? Have you got your patent? Are you wait? So the weightage will differ basis which industry you're in, and these kind of and also our we keep refining this algorithm basis our understanding and also how our portfolio is doing. Remember, we've been in the business for now 15 years, so we have a 250 strong portfolio. So we don't just need to throw uh, intuition at the formula. We have data, so we're being able to throw data so I think that's how it is.
Okay, very interesting. I understand now why you said there will be a version 1000.
Yeah. Absolutely.
Right, right. Okay.
So now this happens, but then see, this is just the machine or this is just technology. Then the human piece comes in, which is which will bring the 50 down to 20. And this is where we will actually go out there and say, look, here are 5 6 rights which are non-negotiable. Please sign this term sheet, Mr. Founder. If you're not signing this term sheet, doesn't matter who you are, we are not taking you ahead.
And what are
So
those rights like?
so I think those are standard ones, right? Like I mean, I think there are about 15 such rights. I don't want to go into all of them on this thing, but stuff like you have to be full time founder. There will be a founder lock in of their, you know, for a period of time that our money is invested in. Information rights. There are some of the ones which are absolutely non-negotiable are preemptive rights, anti-dilution.
What are, I mean, I'm pretty sure a lot of people don't understand what these rights are. If you can, I think it would be lovely to just understand what these imply and what is
Yeah,
the
I
way in
mean,
which.
like I said, each one of them actually will take a pretty long discussion, but let me just try and throw some light on this. Preemptive basically is one of the rights that all early stage investors across the globe will fight for. And
And what
like,
does it mean?
it basically means that whenever there is a next round of funding, okay, I will have the right to invest more at that valuation to retain my same ownership in the company today. Which means that if today, say, assuming I have got 10% of your company, okay, next round, whatever be the valuation, I will have the right to up my investing so that I can retain the 10%.
Got it. Okay.
And this
And
this actually is how wealth is created in the startup space by early stage investors. So anybody who has done this long enough will keep upping their investment in the companies that are being able to raise more money at the higher valuation because of the preemptive rights.
okay, okay, okay. So this would be the difference between getting a, like, say, a 5x return versus a 50x return.
Yes, and because see, for example, if you started out with a company at a 10% stake, okay, over a period of time, more rounds have happened and you have not invested more and you've become 1%. You will always get what is the share of the company as a return, you know. So there's a huge difference in what is shown in the newspapers versus what investors make at each deal. So at each deal, every guy makes a different return actually.
But if you had 10% at 10 million, which means your share was worth 1 million, and then the company becomes worth 200 million, and you have 1%, you're still doubling your money. Uh,
No, so you're not there to double your money, no, Akshay.
yeah, okay.
You are actually there to find a way to make it 100x.
Right. Okay. Got
Yeah,
it.
and also what happens is that in the subsequent rounds, say for example, like in your same example, at the next round, I could have I could have three choices. I could have a choice that I will just stay invested. There are a lot of people, so there are no right or wrong strategies. So a lot of early stage investors do that. They say we will not put money in the next round. Whatever is the investment is there, fine. So like you rightly said, let it become 3x, 4x. I will get that. That's fine. So that's strategy one. Strategy two is to actually exit. So a lot of people actually say the next time a company is getting an exit, I will come out because I'm I'm only a Series A investor, for example, and I will redeploy the money elsewhere. I don't think it's a very wise decision, but everybody has their own format, right? Or there are investors who actually I look at as eternal investors. Okay, eternal investors are people who will say, "I will not exit a company till I'm kicked out." Yeah, and I will do that by doubling my investing as and when the opportunity comes. So what happens is that, and I have seen that strategy being used by prolific financial angel investors, right? So I'm talking of, see, there are two types of invest. Sorry, I'm just jumping from uh, topic to topic, and let me know if it becomes risky. So there would be these operational, hands-on, high intensity individual investors who will say, listen, I have a, and they necessarily need to have a larger kitty to themselves, say 100 crores. Okay, I'm just giving a number. They will say, I will put this 100 crores in 15 to 20 companies. I will have a substantial stake and I will actually be, uh, you know, uh, participating in the growth actively. So I don't like to use the word mentoring and coaching and all that, because I actually think these are completely over abused terms. But if you're actually being able to add value, and I think
Like
add value
make
is,
introductions and stuff like
yes,
that.
only two things. Can you bring sales? Actually, three. Can you bring sales? Can you bring money? Can you find the right people?
Hmm. Right.
Anything
Okay.
beyond that, my view, you should have the confidence of the founder that they pick up the phone and talk to you, not the other way around. If you are picking up the phone and telling the founder, listen, I think you need a difference in strategy, I think you've got the game wrong. Yeah. So these are the things. Everything else needs to be a pull from the founder. So that's the active operational investor. That's a different kind of an investor. And then there is a financial investor, and we actually deal a lot with financial investors on a platform like ours. There the strategy, and I've seen that strategy work with a lot of people who do this, is where the portfolio will be as large as 100 companies, 200 companies. Okay, and you actually put money in 200 companies in the first round, and then you start utilizing the preemptive. You start doubling up on the ones that are doing well. So over a period of time you will have a concentrated portfolio of say 20 companies that are doing well and 150 that are not. But that's, you understand that that's the nature of the game, and you are going with it. So yeah, so that's
Okay, okay, okay. Amazing. What are the other rights? So this is preemptive.
yeah,
You said
preemptive.
anti-dilution.
So anti-dilution is very clear. It is about saying that if at any point of time you are raising money at a valuation lower than what we have raised money at. So assuming you have raised money with us at a 10 million, basis that I have got a 10% stake in the company. Tomorrow, if you are not being able to raise money at 10 million and you say, oh, my business is faltering and I need to raise money at 8 million, for example, as an investor you will say that please, the founder, you will dilute the shares, I will not dilute.
This is what happened, or I read about something was likely to happen with Farmeasy.
Yes, that's
After
correct.
they acquired Thyrocare, there was an anti-dilution clause, and their current
Yes.
fundraise is going to be at a much lower valuation, and founders will end up with very tiny stake. Uh,
Yes, that's a
okay,
standard clause actually. I think in this case it just just came out as a point of discussion in the wider space. But yeah, within the industry, I think all founders and all investors fully understand the implication of this clause. So I think that's the other one. Then the other one that we will just not negotiate on is information rights. So what happens is, so there are information rights, and then there's something called affirmative voting matters, AVMs. So information rights are saying that look, you are an unlisted company, we need to have access to your books of accounts at any given point of time. So it's not just saying you give information to us and on a quarterly basis you will come, and so that is a that is a given that you will come back on this thing. But I have the right to look at your books at any given point of time, and you cannot block me.
right,
That's the
right.
one. And then
Yeah,
there
this
is,
sounds very reasonable. Like it's a very
yeah.
reasonable ask.
See, and then of course there's something called affirmative voting rights, where there is a list of things that are there. For example, if you're pivoting the business, you have to take our okay. If there are three founders and one wants to quit, you need to be okay. If you're suddenly creating an ESOP pool, you need to be okay. For sure, anytime you're taking debt and you're taking raising further equity, you have to take an okay from us. So it's a list of what I think what we need to understand, and I think it's the right point, for me to highlight over there, that I've actually seen a large number of founders not even being aware of these nuances when they come and talk to us. I think it is so important for founders to understand. Look, I think what has started happening now is it has become fashionable to say I'm raising money. You know, it has become fashionable to say I'm raising money at this valuation. What we need to understand is that nothing comes for free. So if you are a founder who's raising money, A, please understand the responsibilities that you are signing up for when you do this. That's at the basic minimum. The worrying thing that I'm seeing now, Akshay, I think I'm seeing this over the last year or so, is that founders don't understand, like while they have signed it in the letter, they are not following it in the spirit. And that is creating, so of course at the larger companies, I don't want to name companies, but you're seeing corporate governance issues which are getting splashed in the newspapers, and there's no and a lot of times you'll find that it's not a question of right or wrong, it's a question of nuances in the documentation. Okay, what is happening is that a lot of that is trickling right down to the early stage level where we operate, and our investors and we ourselves have started asking a lot tougher questions at that stage on A, what's your corporate governance, B, do you actually understand what it means to raise money, and C, are you up to actually complying with all of it. My fear is, Akshay, if we don't do this, and it's a good time right now to do this, because of course there is a flux in the industry, there is a slowdown in funding, etc., not at our level, but in the next levels. This is the right time to take a pause and put those structural things in place. Absolutely critical. Yeah. So
Okay, very interesting. Got it. Okay, so this is post homogenization. You have these rights of investors, and we covered a few of them, which you get them to sign off on. Then what's the next step?
they have to accept.
Right. Okay.
So they've accepted, and then of course we will look at claim validation, where saying that if the founder said, listen, I have these 5 customers, we will talk to the customers, we'll try and do virtual site visits, we'll try to do real site visits, we'll do product sampling, we will look at the financials, at the thing, we look at the cap table, we will look at the structuring, a lot of first level checks, to say, basically saying, even before we bring it to our investors, and even before we do a deep dive in due diligence, is this company looking more or less okay to be able to be produced to our investors. So that is the homogenization part. Then what happens then, say, assuming now I've said 20 have, so 500 to 20 have come. Then what we do is that through our various mediums that we speak to our investors, we have an app, we run a WhatsApp group, we have we do mailers, we do we actually do physical showcases, we do virtual showcases, we do what is called a deep dive with the founders, etc. We basically try and get the founder in front of the investors in as many ways that we can, in putting the information out in a way that the investor has started expecting from us. So imagine if there were 20 founders, they will have one pitch deck. Each will look different. There is no way that we will go and change the pitch deck for each founder. Our synthesis and summary of it and analysis of it looks the same. So the investor gets that one page of saying, okay, here are the 10 things, saying. Now that happens. Post that is when people will say, yes, we are interested in investing. So this is the homogenization, showcasing, book building done. Okay. Now assuming we've got the, so we were trying to raise 2 crores, 2 crores have been verbally or written committed. Now we will do the due diligence. This is when we bring external third party uh, partners who will do legal, financial, secretarial. They will do background checks. That itself takes a couple of weeks. So then what will happen is that this is so.
So what for an early stage startup? What is left after you've already done your internal due diligence? What is it that this external partner does? Like a check if there's any cases against the
Yeah,
founders or the company. And
and also see at that level, till that level, no, we've actually not gone and said, has this guy done all the filings with MCA?
okay,
Have all the secretarial things been done?
compliances. Okay.
Compliances, legal, are the books of accounts in order? We would not have actually looked at it, almost think of it like an audit.
Got
We've
it.
not done an
Okay.
audit type of a lens on numbers.
Okay.
uh, Actually looking at invoices, looking at
Ah,
almost all,
whether
like,
the revenue is real or right.
yeah,
Okay.
exactly,
Okay.
exactly. And then doing, okay, cases, like everything, right? Then the third party partner will give us a due diligence report, which will come to us. Then there is a back and forth between us and the founder on, say, questions that have been raised by the third party partner, and they say, we are not comfortable with this, or these things need answers, etc. Then the founder answers it, etc. Now there is this decision point that we have as Mumbai Angels to say, yes, we are comfortable with the due diligence outcome, or we are not. If we are not, we will drop the deal irrespective of the amount that has been committed. And we do that regularly. So there have been
What is
several,
the percentage?
not too high of the numbers, because I mean, I would say committed in this thing, say about 2 to 3%, but we
Okay.
will do it. We will do it. Uh, And we are very clear that, we are not going to invest in hurry and then manage it in, pain over the next 4 5 years. We've seen this so many times over and over again, Akshay, that I think it's better to drop a deal at the beginning than just say, oh, money's coming in. And because, like I said, our primary client is the investor. We are answerable to them, because it's their money. So we are a money manager, right? We are a wealth manager. So so we will say, okay, this is done. So once the due diligence is over, is we say, okay, now we are doing the deal. That again, post that also, it takes a couple of weeks, because then you do the fine tuning of the shareholding agreement. So, we've said that, look, here are 10 things that are non-negotiable, but the shareholder agreement is actually 80-page document. So you will go back forth back, it's a legal document like any other, and then you will close it, etc. And now, because it goes through the fund process, then of course, we will go back to our LPs. They will say yes or no, and then that whole thing happens. Investment done. So that's the second part, due diligence and investment. Then is when you will actually start working. you know I will not say that we are operational partners, so I'm not saying we will actually start working with the companies. We are managing the information for our investors, and timely intervention whenever we see something is not going right. Okay. So that process, depending on, so unfortunately, if a company has to die, it dies within the first 3 to 4 years or earlier. The ones that do well, they of course stay on longer. So we've actually seen, so like, say for example, in Mobi, which is our first unicorn, that investment was done way back in 2007. Purple, which is the second unicorn, is in 2011. So it takes that much time for companies, and I would think that there are at least 20 to 30 companies in line in our portfolio, which are doing really well. So that's again, the number is anywhere between 10 to 15% of your portfolio, which are going to give us these supernormal returns over the entire thing.
So your role at this stage is providing like quarterly updates to the investors and
No,
uh,
of course we are. Of
hmm,
course we are. So we
hmm,
actually do uh, monthly. So we actually do like a monthly touch point with the founders, which is
okay.
a monthly this thing, and then of course there's a quarterly. You have to do a call with us. You come on this thing, and uh, so there are, so like I mentioned, till about last year we were still doing the direct on the cap table. So there the investor is more engaged, because they are on the cap table primarily. And now of course we do this via our angel fund. So now we do the calls, we will be involved. So then we become like any other fund. We will give quarterly updates to our investors on a, almost like saying, okay, here is your portfolio, this is what how it's doing, etc.
Okay. Help me understand that transition from each angel investor coming on the cap table to only one single entry in the cap table.
So
Why
it's a,
did you want to change it, and how, like, how is it structured now? Like, from a technical point of view.
yeah, absolutely. So look, I think the several names on the cap table structure is not sustainable only, because what happens is that, so when we were doing several names on the cap table, we were basically, um, you know our investors were not paying us per deal. They were paying a membership fee, which was the same whether you did 20 deals with us a year or zero. So you paid an annual fee, and you see, and
You,
we
you
were
didn't charge like on a assets under management kind of a model.
no, nothing. So that,
Okay.
because
Okay.
so this was an earlier format. I'm talking
Right.
of the
Okay.
pre-fund,
Hmm.
and we used to charge the founders a 5% fee, which was 3% in cash and 2 in equity. So we
This
were,
is one time when the deal is done.
yes, one time the deal is
Okay.
done. So like say for
Okay.
example, if you're raising a crore, the investor for that crore pays nothing to us, and
Hmm.
the founder was paying 5 lakhs, of which 3 was in cash and 2 was equity worth 2 lakhs in that thing.
Okay.
So that was how it was being done. Now, So I've actually been a part of this conversation with SEBI on, the angel fund, etc. Way back, I think 2018 onwards is when these conversations started, 17, 18. Now SEBI is very clear that platforms which are doing direct on the cap table are actually not under any jurisdiction in the country. So SEBI says I will not monitor you. RBI says I will not monitor you, which means that at any given point of time they can just come back and say what you're doing is illegal. Okay. So SEBI said, so it was driven from SEBI saying you guys need to get inside a fund structure. Okay. However, you cannot do a fund structure in angel funding or early stage venture funding because the primary nature of investing is individual investors taking their own call. You can't take that away and say it's a blind pool. Then I'm just one more fund as the rest 730 funds in the country. Okay. So what is this angel fund structure? It's a very innovative structure that SEBI has come up with, and it has some of these they are in some format or the other are there in all other countries. Which is basically it's a deal by deal investing. So instead of looking at it as angel or not angel, the term to use is deal by deal investing. So how this is structured is it is structured in its shape and format. It is like any other fund in the country. So you register it with SEBI. Like say for example, we have 1,000 crore fund registered with SEBI, which has a life of 22 years. Okay. However, the similarity between any other fund and this actually starts reducing from this point onwards. So, primarily, what happens is that in any other fund, the fund manager would have the ability to deploy that 1,000 crore basis their processes and their calls. Here, what we were doing earlier of 500 to 20 remains the same. Even 20 to getting people to invest remains the same. People will choose, we will show the same information, etc., etc. The point where somebody says yes, I'm interested is when it changes. Where earlier we would say, okay, 20 of you, you've said 5 lakhs each, okay, please become we will facilitate, you will become names on the cap table directly. Now they become LPs with us in our fund, and we allocate units for that specific investment to only these 20 people. And what has changed in our revenue model is that now we don't charge the founders anything. So we are now actually the cheapest in the market today, where our cost to founders is zero. So we don't charge anything to the founders. To our investors, we charge a one-time 2% fee to get the transaction done. And then uh, when there is profits, we will first return their capital. So if say for example somebody is invested a crore in a certain company with us, and at the end of say 5 years that company returns to them 1 crore, say 2 crores. Okay. So they will first get their 1 crore back, and of the profit that is being made, which is 1 crore, we will keep 10% and the investor gets 90. So it's a 90-10. Thing.
Wait, 10% sounds low, right? The industry norm is 20%, no?
It's all over the
20%
place.
of this is called carry, right? Like
Carry.
the
This is carry.
jargon. Uh,
This is carry. I think it is all over the place. So what's happening is that, see, uh, sorry, I think that's something that we didn't mention early on. We are now part of 361. We got acquired last year. So we now have the ability to be able to set uh, terms and processes that can sustain in the long term in the industry, right? What we saw is that there's this full range. Somebody is charging 20, somebody is charging 2, you know then somebody is charging 15 but sharing 5 with somebody else all over, and then they're doing deal by deal and this and that. We said no, this is not how we will function. We will set the industry standard to say 210, which means that as compared to peers, we would sometimes make lower in one company and higher in one, but the idea is to be able to do this on a homogeneous standardized way. So I actually um, While, so what happens is that some deals sometimes we might look more expensive, like I mentioned, because some other guy will say, oh, we are charging only 2% on this. But on an overall basis, we are now the cheapest and the most transparent in the industry.
Sorry. Okay. Is there do you have a thesis on why 10%? Like that 10% is the best rate for early stage investing?
So like I said, we did a lot of thinking around this, Akshay. So what happens is now that, look, what happens is that a lot of guys, they are actually charging 20%, but they are sharing almost up to 15% with an external partner.
People
So
who
a
are
deal,
recommending the deal, like who are doing deal sourcing.
not just recommending, but somebody who's running with the deal. So you could just come in and say, look, I'm the deal lead. I found the deal. I will run it. I'm responsible. So the platform actually gets only 5%. It just looks like you're charging 20, but you're saying, then there is this whole thing where the same platform will say, oh, if it's done by a third person, it's 20. This deal, however, we're doing on our own, so it's 5%. So I said, it doesn't make sense. Let I should not be asking an investor to choose a company where on an upfront basis this looks cheaper than the other one. I'm not asking them to choose a cheaper one, I'm asking them to choose the best one. So the best way to do that is to take the pricing decision away deal by deal. And if I had put it at to 20%, I would have been the most expensive in the market. And I don't want to play this, game of 5% to 20% deal by deal. I said, let's go standard, average 10%. And our back math says, whether you were doing this deal by deal or you did a 10, you will make the same money if the quality of the deals were same between us and a peer.
You spoke of that there are two types of funds: a deal by deal fund and a regular fund. A regular fund is also, you use the term blind pool for it, so which means that for a regular fund, they go and sell the the team and the track record to investors and say we will handle your money. So it's almost like selling a wealth management service. And the investor commits, let's say, okay, I commit 100 crores, so that 100 crores is committed, and then the investor has no say in where it is invested. The
Not really, Akshay. So we actually have two funds even today. So we actually speak. So we have an angel fund, which is a deal by deal, and we have a blind pool. Now let's just understand what are we doing in this. So I think the deal by deal angel fund we discussed in detail. So that contours are more or less clear. What we see is, as investors stay with us and they do this, so assuming they've been with us for a year and a half, and they've invested in 20 companies, until and unless they are actually spending, say, 30% of their time on this asset class, this starts becoming overwhelming. Imagine if you had to look at four different deals of four different sectors every week. You would have to do this full time, right? So a lot of investors actually come back to us and they say, look, can you give us a mechanism where we invest in all deals that are closing on your platform? So it almost becomes like an index product, which is what our Cat 1, the regular blind pool, is there today also. So we talk about both these funds to all our investors simultaneously. So it is up to you, what do you want to choose. So you will say, I will either want to choose everything on my own, so it's an angel fund, or make it an index where everything that closes with you on the angel fund, I will get a pie of. So that
okay.
is how our Cat 1 is structured. Then of course there are a lot of other Cat 1s, a lot of funds, and not just, I'm actually using a wrong term. Cat 1 is just a class of funds, but any blind pool fund that is there across the world, it is basically you commit a certain amount of money and then the GP and the team takes call on it. Then yeah, absolutely.
And the money you commit doesn't have to be given upfront, right? You
There's a
give
drawdown.
as.
There's a drawdown schedule. Like, say, for example, for us, in our regular blind pool, we are saying 30% needs to be, will be drawn down on day one. and the minimum ticket size over there by law is a crore. So if you will commit, so if you'll say I'll do the minimum, so it's a crore, so you will give a 30 lakhs upfront, and then we have the right to call for it over a period of time, and we actually give a range, because we also don't know. So we say, okay, next 12 to 18 months we could call, and it could be further also.
So your blind pool fund, what is the like? What is the size of it? Like how many crores?
That's a smaller fund, so it's a 300 crore fund. So
Okay.
the mechanism over there is that we are saying, if I'm going to close a crore on the platform, I will put 25 lakhs more from the cat one into it. So it's a 25% of the amount being raised. So
Okay.
it needs that much lesser money.
Got it. Interesting. Uh, your primary fund, the deal by deal fund, is the 1,000 crore fund.
Yes, that's correct.
Why is there a number here of 1,000 crores? Because you may not. E- People are choosing. So I don't understand why you call it a 1,000 crore fund. What does
No,
that
so
mean?
you're absolutely right. You're absolutely right. So actually, when you file for a fund license with SEBI, you have to file with a certain number in mind. So that's it's a structure that is out there. Now, this money, as opposed to say in the blind pool where I will actually draw down money, here my goal is to say how much can I deploy year on year. So for example, if this year if I can deploy 200 crores out of that, next year 300 crores. So like say for example, I think this 1000 crores will actually get exhausted. So I have a life of a 22-year on the fund, but my view is we will actually exhaust it within 4 to 5 years max, and we will so that 1000 crore will get deployed over, I would say about say 500 companies over the next 4 to 5 years. That's the math. And then you actually let those companies grow to their potential for the next 16 to 18 years. That's the journey that it will have.
Once this 1,000 crores is deployed, then you can't participate in follow-on fundraisers.
uh, I will have to,
And
so there yeah, two
those
parts
those
there. One
follow-on
is,
fundraisers are part of this only. Like
yeah. So follow on fundraisers, there is a cap by law that in a single fund I can only deploy maximum 10 crores in a certain company. So I could do 4 rounds, but I can only deploy 1000 crores, 10 crores in a certain company. So I can do follow-ons for sure. Within this fund, I have a 1000 crore plus 200 crores green shoe option, which means I can choose to do it or not choose to do it. But how I see this panning out is in say about say 3 4 years time, I will launch another fund for, like say for example, this, I actually think this is like a testing ground for us, right? We'll see how are these 1000 crores operating. Then our next fund can be for 5000 crores or 10,000 crores depending on our read on is there that market size, or you can actually do a 99-year fund for 10,000 crores. You know what I'm saying? So there are a lot of structures possible.
okay. And what does this 21 years imply? That you have to return the money within 21 years?
Yes, yes. So the life, so because the the fund structure, by structure, it's not an eternal structure. So a company, for example, it's an eternal structure. A fund comes with a end life in which is defined. So in this case, it is 22 years.
What happens if you don't get exits? Although it's a very large period, but I mean,
No, it's a valid
hypothetically,
question. Yeah,
yeah.
it's a valid question. It's not. So forget about us. All funds face this challenge all the time across the world. So, like say for example, here is 22. There are funds which are say in the listed space, or where the life is only 4 years, 5 years. Late stage private equity maximum will be 7 to 8 years, 10 years. Doesn't go beyond that. So you will have to sell. So a lot of times, when say for example you see large funds actually exiting a company at a haircut, chances are they're doing it because their fund is coming to the end of its life.
Got it, got it. Or they could sell it to the next fund. Like you invested
No,
from
no,
fund
no,
one,
that
then
is,
you sell
no,
it to
no, no,
fund two. You can't
no,
do
no,
that. You can't. Okay.
Because see, then it's a conflict of interest, no? It's a conflict of interest. Then you're basically, um, even if a single LP is missing or added to the other one, then the value gets transferred. So I think there are some minimal amount that you can transfer, but otherwise, see, otherwise it's a conflict of interest. No, you have to be very very careful on where is the value getting transferred to whom. It's not just so. Say for example, think of it this way: 1,000 crores, Mumbai Angel Fund. At one point of time, there will be 1,000 LPs whose money will be deployed, or more than 1,000 actually. So I cannot transfer money from here to there. No, it is their money that gets.
Okay. So you said you've been acquired by 361. What does
Yes.
that mean?
So we got acquired. So we were three of us in who were co-founders and owners of Mumbai Angels, and now 361 has acquired us.
And
So
Mumbai
now,
is like a private limited entity.
yes, it's a
Okay.
private
Okay.
limited entity which has got
Okay.
acquired by three. So it's like an exit in any other company.
Hmm.
So, like say for
Okay.
example, we have three founders. We've taken an exit, and it's I continue to lead Mumbai Angels as a part of 361. So
And
now, yeah,
361 is like 100% owner of Mumbai Indians.
yeah, I think it's a 91. So there's
Okay.
still some residual stake left. But yeah, for all practical purposes, it's a thing. And 361, as you might be aware,
Wo-
it's a listed entity. It
No, I'm
is one.
not aware. What is
No,
361? Yeah.
so 361 is, the erstwhile IFL. So there are two IFL. So there's IFL Securities, and there was IFL Wealth and Asset Management. So we've got acquired by the IFL Wealth and Asset Management Company, which actually manages wealth worth $41 billion, and
Wow.
it is the largest private wealth manager, private asset manager in the country, and it's a listed entity. Uh, it is so we are now a company within a company, and they look at us as another asset class that they can offer to their uh, you know
They are
wealth
in
housing.
the HNI wealth management space.
Yes, absolutely. So it is
Okay.
almost all big names in the country would be clients of 361.
And what do you do when you're doing wealth management for HNI? This is not the same as, let's say, putting money of people into mutual funds.
No, it is. It is a full. So the wealth management. So this company has two divisions. One is wealth. Second is asset. Wealth is where you're actually sitting with somebody who says, "Listen, I have 1,000 crores to deploy. How can you structure it for me?" So they have the whole bouquet of assets. They will do the asset allocation. They will manage it for you, and so that is the wealth piece of it. And
And they will
asset.
earn commissions, like,
Yeah, so it's
let's say,
like any. Yeah.
uh,
So it's a product sale and
hmm.
managing. So it's a
The
relationship
way like a financial advisor earns commission on mutual fund sales,
in
they
a
would
in
earn
a
that.
yeah,
But
yeah,
like
in
very
a much
crude,
wider thing.
crude
Yeah.
analogy. But because they would be doing a lot more, they would be selling them debt and maybe direct equity investments and so
And
on. And
managing it fully, so
okay.
what you're talking of is the top 0.1% of the country,
Hmm.
uh, banking on 361 to manage their wealth.
Okay.
So that's
Okay.
so they have, I think, 7,000 families. So it's a very
This would
small.
be structured as a PMS, like a portfolio management service.
Different things, no? So the wealth piece is a different piece where the RM will go, and they don't really need to sell 361 products. They will sell all the entire gamut. Then
Okay.
if you say that, look, I want to invest in real estate, they will have the ability to get you to buy real estate. It's that whole full wealth. So wealth management is an industry,
Yeah.
by itself.
Right. Right. Okay.
And then there is the asset management part of it, which is where they have their own mutual funds. They have large private equity funds. They have uh, we manage, I think, within the 361 thing, about 25,000 crores in various funds that are there. So Mumbai
Okay.
Angels now becomes a part of the bouquet that's getting offered. So it's a very good fit. Um, yeah, so I think that's what the 361 this thing is.
Yeah,
And this is
361
actually,
then will take care of your capital needs. Like I'm assuming like 1,000 crores is like a drop in the bucket for a
no,
company like
they
361
will
to.
not invest. So the
No, as
thousand,
in like selling it to investors and getting you
yeah, yeah,
access.
yeah. Absolutely, absolutely. And what they are doing is actually putting a lot of investments in tech for us. So I actually see us as a D2C tech play, and we had not managed to put any investment in tech pre the acquisition. Now there will be a lot of investing in tech, people, processes, uh, access to information, SEBI, so that whole you suddenly jump start into what you would have done independently, say 5 years. So that's
Wow,
the
amazing.
so
Okay.
that I think that's what it is. I think it's the first of its kind acquisition in this space globally. So it's
Yeah,
you've not seen
yeah,
any other.
yeah, yeah. Absolutely, it's highly unusual. So my last question or series of questions to you is advice for founders. At the early stage, founders are extremely confused. These are typically people who have very less exposure of how to do fundraise. They maybe quit a job with a passion for an idea that they want to build. They might have built something, and there are a lot of these preconceived notions on how funding happens because of the headlines you read.
Yeah, yeah,
uh, so can you like give a reality check to people?
absolutely. So I think a couple of things, right? One is don't raise money till you really need it. I think that it'll sound very strange coming from me, but please understand that raising external money is like getting into a marriage with an end date. So you actually get into a marriage with a divorce date in place, where the investor is saying that I'm coming in, I'm giving you this money. Please tell me when can you give me an exit? And if you don't give me an exit in 5 years, here are these three, four things that you. So that's, and also when an investor comes in, they are not going to be silent investors. You should only look for somebody who you're okay to be sitting on the same table as you. That is number one. The second one is that before doing your rounds, thankfully today in the Indian ecosystem, we are matured enough, for the last say 15, 20 years, the industry is there. And of course, you have international, lot of data, etc. The founders should do a lot of reading. You should do a lot. Don't just blindfold walk into saying I want to raise money. Do a lot of reading. Listen to podcasts, listen to uh, you know uh, speaker conversations, go to various panel discussions, go to conferences, become smart about, like, you have to learn this. Fundraise is an art, it's a craft, and you can't walk into it blindfold. So you have to know what you are doing, right? Second piece. Third is understand it's a sales process. So like with every sales process, uh, your success ratio is going to be 5%, which means irrespective of who you are, you will have to talk to a minimum 100 investors, of which only 5 will actually give you a meeting and of which one will convert. If you are getting tired of it, this won't work. You have to repeat the same thing over and over and over again, and you can't lose patience because every guy is going to ask you as many questions, right? So here are these three, four things. Fourth is don't walk into fundraise with a valuation in mind. I have seen this happen so often. You're irrespective of where you are, you're like, I can only dilute 10%. Doesn't work like that. you know you will have to, like I said, before you put a valuation number out, you should have a very strong logic on why you're doing it, and it cannot just be a fictitious excel sheet which says today I'm doing 2 lakhs worth revenue, but guess what, in 3 years I'll be doing 100 crores. It could work couple of years back, today it doesn't, especially today it doesn't. So don't have a fixed valuation number in mind. Talk to the first 5 6 investors by saying, listen, I'm open to valuation, you tell me. So you start getting that. It's a price discovery, understand, as you become more established, there is data to show what your valuation could be. At the earliest stage, it's a price discovery. And honestly, the only price that matters is what somebody is willing to give a check for. Like somebody, I'm just giving you a story or this thing. Somebody just called me, a week back and saying, "Look, I'm trying to do this business, and I think I'm worth 100 crores. What do you think?" I said, "Look, what I think doesn't matter. You have to ask me, am I willing to cut a check at 100 crore valuation? If I say I think it's a very good thing, and I'm not cutting the check, that means I don't agree to that, right? And if somebody else is coming and they're willing to cut a check at a 20 crore, that's the valuation. That's just the thing. The other piece is on, start raising smaller amounts of money. Take smaller amount, build, then raise, build. I've seen a lot of people saying, "Oh, I can't start this business till I raise $1 million." Guess what? Nobody cares. Your business will never take off. Better to go out there and raise 50 lakhs, build, do the hard work. So that uh, you have to have that tenacity to build this out, I think. And the last bit that I'm going to, I'm actually quite worried about it, because I see it, like I was mentioning right in the beginning, corporate governance. Please understand, corporate governance is not just about larger companies and listed entities and this thing. So a lot of us think, oh, a larger listed company should follow rules, but I am okay to do, shortcuts, because I think we have actually got stuck with a very bad term in the Indian market called jugaad. Jugaad means hustling. It doesn't mean cutting corners. You see, so you with jugaad you will only reach so much. If you're really wanting to become a true, uh, you know, build something of scale that matters, jugaad will not work. You will have to bring in the right processes, and now is the time to do this.
Okay, so you have shared a lot of very very practical advice for founders who are seeking to raise funds. Um, One of the things you said was don't raise before you need money,
Yes.
um, which, I mean, to be honest, as a founder, you're always looking for money, right? How do you distinguish between needing money and wanting money? I think that's what you're trying to make as a point here, right? Don't raise because you want money, raise because you need money. How do you distinguish between when you need it and when you want it?
See, I think there are two very critical, ways to check that do you actually need money or not. One is, of course, your P&L. Okay, so you when you start out a business, you first have to put out saying, okay, it's very clear, whether you've not raised money or not. What are your numbers telling you? So your numbers have to say so. Like for us, if you ask me that, okay, what is that one critical uh, metric that I will follow for all companies at all times? It's basically the runway. How
Okay.
much more you have to survive? Everything else, if you ask me, actually is all fluff. So that's the runway. Now, when is it that you have to start looking for money? You have to start looking for money when either you are starting out at zero capital. That I actually think is a very tough spot to be in, where you're saying, and I think actually it's romanticized nowadays too much because of movies and everything, saying that you can make, you can change the world through an idea. I'm not denying that. I'm just saying that there needs to be a heavy dose of realism in that statement. And until unless you're trying to actually build something out which is a tech product, or which doesn't need too much money to be input in the beginning, you do need some capital. So the early capital that will come in will come from friends, family, which, say, assuming is like, say anywhere between 20 to 50 lakhs is the number, I think, where you can actually go out to friendly people, friendlies in the world, basically saying, I'm starting out. So that's the number that you do. If you are not being able to raise that also before you're starting out, I think you're in a very tough spot. So you have to rethink that whole business. When I said,
look for money when you really need it. I actually mean the amount post that. So when you are wanting to raise money post your initial takeoff, or you've done your first POCs, you've done your first MVP, everything is done. At that point, I actually see a lot of founders actually think that raising money is the business. It isn't.
Okay.
It is not about going to parties. It's not a brag right to go and say I've raised money, because you know you and I have seen this enough for longer periods of time, that you could actually be raising money for 10 years and then one day you will just go zero if you've not got the basics right.